volume accumulation setup. It's my most favorite setup of all the setups. And I look for this setup when I see a price action channel like this one. This is a sideways price action channel, or a rotation. And why I look for rotation? Because it takes time to build up a position. Now I'm talking about the institutions who need time to build up a position. So they do it in rotation, they do it in sideways price action. And they do it slowly, they don't want anybody to notice that, so they need to do it slowly. They do it in rotation when nobody can see it, and after that they initiate either strong buying activity or strong selling activity. In this case it's strong buying activity. So when I see sideways price action like that in the picture, and from this sideways price action initiation of strong buying activity or strong selling activity, I use the flexible volume profile and I select the area with the rotation. So I select this rectangle. Why I do that? Because I want to see where the volumes, how the volumes were distributed throughout this whole area. And when I select it, I see, for example, in this case, that the heaviest volumes were right there. This is the place where the volume profile was the thickest, or is the thickest. So I draw a line from there and I wait. I wait for the price to come back to this area, and in this case I go long from there. What is the logic behind this? The logic is those volumes were volumes of strong buyers, alright, because they pushed the price upward. So because of that we know that those were volumes of strong buyers. When the price comes back to the area where the buyers entered most of their positions, those buyers will be defending their positions and they'll push the price upwards from this area. They'll push the price upwards to defend their positions, to defend their interests. And that's the move you are waiting for. This is the price, this is the place where you enter a position, this is where you go long, this is the movement you want to participate on. Alright, I hope this makes sense. This is the reason number one why this setup works. The reason number two is, let's say that those guys who are accumulating their buying positions there, they push the price upwards, but they got rid of their positions there. So they don't really need to defend their positions there because they don't have any. But the sellers who are pushing the price lower don't know that. They don't know that those buyers won't be defending their positions. So what the sellers do is they quit their selling positions right there because they don't want to risk a fight with potential strong buyers. So they close their positions in this area, and you probably know that when you have a selling position you need to enter a buy order to get rid of the position. So they enter a long positions or they close their positions, which drives the price upwards from this area. This is what drives the price upwards. So there are actually two reasons for this scenario, for this setup to work. Alright, I hope that is clear enough. I'll just show you two examples so the setup is more clear. I would really like to teach you this setup so you can try it on your own, try to backtest it and look how good it works. So right there you can see a volume accumulation area, sideways price action. Alright, so you can select, you can actually select this whole area, not just this place I selected, but it doesn't really matter in this case. you can see that the heaviest volumes within this rotation area were right there. This is the place where the volumes were the thickest. Right after that, you see that there was a very strong selling activity, which indicates that those volumes were volumes of strong sellers who pushed the price lower. So what you do is you draw a line from the place where the volumes were the thickest in the accumulation area, and then you wait for a pullback until the price hits the line you've drawn, and in this case you go short. You enter the market with a limit order. You don't need to wait for any sort of confirmation. You just enter your trade there. Only thing you need to be careful about is that you don't trade during macroeconomic news. But other than that, you are all set if you just trade with a simple limit orders. Let's have a look at the second example. In this case, you can see that there was a sideways price action right there. So again, you select the area with the sideways price action, and you look at the volumes within this area, and you see that the heaviest volumes accumulated in this area were right there. This is the place where the institutions placed most of their volumes. So you draw a line, and you wait. You see that there was a strong buying activity, so you know that those volumes were volumes of strong buyers. So you are waiting for a long trade. And when the price returns to this area where the volumes were the heaviest, you go long from there. And that's it.